start the call with some opening remarks from Amitabh, and then we will talk about the third quarter results. Amitabh, over to you.
Thank you, Jairam. Good evening, everyone, and wish you all a very happy new year. We welcome you all to a discussion on Axis Bank's financial results for Qtr3 FY19. Before we get into financial performance or strategy, let me start with a personal note. This is my first interaction with you all as the MD and CEO of Axis Bank. It is an incredible honor and privilege for me to lead Axis, a bank that has built an enviable franchise over the past 25 years. For building this great institution, it is important that I thank all my predecessors, Ms. Shikha Sharma, Mr. P.J. Nayak, and Mr. Supriyo Gupta. Over the last 10 years, Axis Bank has gone from strength to strength, growing by 4 to 5 times on most major parameters: balance sheet size, CASA, advances, number of branches, operating profits, etc. We have done exceedingly well in retail banking, in credit cards, mobile banking, and digital. We have the strongest debt capital markets franchise in the country and a strong SME business. We also have well-established relationships across a number of our wholesale clients. The bank has also established its presence through subsidiaries in major businesses that are contiguous to banking, such as non-banking finance, retail broking, asset management, institutional equities, and investment banking, where we have one of the best equity capital market franchises in the country with Axis Capital. Axis is the only bank with 2 fintech companies as subsidiaries, one in the payment space and other in the digital invoice discounting space, where they have more than 40% market share. All these businesses complement the parent bank strategy to offer our customers a comprehensive offering under one Axis umbrella. The impact is reflected in the Axis brand, which has consistently ranked amongst the most valuable brands in India. Having said this, I must also acknowledge that in the recent few years, the bank has faced some headwinds, especially on the asset quality front, driven by corporate slippages. The bank's financial performance, too, has moderated, and corporate loans have grown below our long-term growth rates. An increase in our operational risk has not helped the cause either. Having joined the bank in this context, over the last couple of months, I've been spending time with the various teams at Axis across business units, risk management and operations to understand our current position and to outline the strategic focus of the organization going forward. I'm glad to share with you where our thinking on our strategy is at this moment. We have uploaded a presentation on our website earlier today in which we have attempted to articulate the strategy Axis Bank would like to execute over the next 3 years. Our strategy for the next 3 years will pivot around delivery of 3 important vectors: growth, profitability, and sustainability. Let me start with growth. India continues to be the fastest growing large economy and has been leading global growth over the last few years. The financial sector in our country has been both a key beneficiary and an important enabler of this growth, thus growing itself at a fairly brisk pace despite the asset quality challenges of the sector. The competitive and market share dynamics of the industry at present continue to favor nimble, well-capitalized, digital-ready private banks. I believe that Axis Bank as a franchise is uniquely positioned to leverage this opportunity and regain its past momentum on growth and profitability quickly. Our market share is still only 4% on deposits and 4.57% on loans. The developments in the markets present us with tremendous opportunity to improve upon these numbers in short order. Our focus over the next 3 years on the growth vector would be to improve deposit growth materially to fund our strong loan growth aspirations, establish leadership in payments and digital capabilities, and to materially scale up our subsidiaries. The second important vector of our strategy is profitability. We would continue to focus on growing our core operating profitability, striving to enhance both margin and fee incomes. We intend to make all significant portfolio mix choices based on an assessment of risk-adjusted return on capital, or ROC. We intend to drive relentless focus on improving our cost efficiency, and of course, most important of all, we intend to reduce the bank's credit costs sustainably below its long-term averages. These moves, we believe, have sufficient potential to bring us back to return ratios that our stakeholders have been used to in the past. The third vector of our strategy is sustainability. While delivery of growth and profitability is really important, we intend to focus just as much on the sustainability of our efforts and outcomes. We are investing in 3 major areas here. We are strengthening our core, be it technology, analytics, operations, or process. We are investing in our risk management architecture. And finally, we are reorienting the organizational structure and building a bench of senior talent to deliver continued excellence. On this front, Rajiv has now taken over charge as ED Wholesale Banking, and Deepak Maheshwari has joined the bank as the Chief Credit Officer. Deepak is a seasoned banker and brings in a rich experience of 40 years in credit management, product design, and underwriting. The idea is to execute in a rigorous and disciplined manner across the organization all the time. An important element in building a sustainable franchise is to embed conservatism in our internal policies and practices. With that in mind, I've been working with the team to identify areas of balance sheet that might require further strengthening. An early step I've taken is to review our corporate portfolio with the team, starting with the large accounts, to assess if there are signs of stress in these accounts that we need to be aware of. My initial review suggests that most of the accounts that are under any stress are indeed tagged as BB in our system. There are the odd accounts where certain judicial processes might create exposure if they turn adverse, but in the main, the BB and below pool seems to cover much of the stress loans. We are also reviewing other aspects of our balance sheet, like non-fund-based exposure in stressed accounts, our security receipts portfolio, non-banking assets, etc. I would like the bank to hold itself to consistently conservative provisioning policies on NPAs. Axis already employs daily tagging of NPAs across all our portfolios, wholesale or retail. Clearly, this is a more conservative policy than the month-end tagging that we had before. In the retail bank, through an approved internal policy, we deploy a provisioning ladder that is at a higher level and more conservative than the regulatory requirements. I would like to assess if we could do something similar in the corporate bank as well. In this regard, we would like to review our provision coverage policies in consultation with our auditors, regulators, and the board, and ensure that we are adequately quick and conservative in provisioning. If we do that, we can also ensure that the transition to Ind AS, as and when it takes place, is much more seamless. We will obviously review this over this next 60 days or so, and if we have to make changes, we'll come back to you as and when we are ready. Our goal at Axis Bank is to deliver 18% ROE on a sustainable basis by focusing on these three vectors: growth, profitability, and sustainability across the Axis franchise. I'm confident that we'll get there sooner rather than later, and I'm happy to be here to lead the organization on that journey. With that, let me hand over to Jairam to take you through the bank's financial performance in the quarter. Jairam.
Thank you very much, Amitabh. Ladies and gentlemen, good evening. It is my pleasure to now take you through the detailed financial performance of the bank during the third quarter. As always, do keep the investor presentation handy, as we do expect to refer to some slides there. There are 5 key highlights of our performance this quarter. Number 1, asset quality metrics, which are progressing well and as per expectation. Number 2, provision coverage continues to get strengthened. Number 3, growth metrics in the quarter continue to be healthy, led by retail. Number 4, deposit franchise had a strong quarter once again. And number 5, profitability metrics, which showed material improvement. We will discuss each of these in some detail over the next few minutes. Let me start with asset quality. Please refer to the asset quality section, starting slide number 47 in the earnings presentation. Slippages continue to remain at moderate levels. Gross slippage in the quarter was 3,746 crores, or 0.7% of gross customer assets, compared to 4,428 crores in the third quarter FY18 and 2,777 crores in the second quarter FY19. Slippages from the corporate segment were at 1,887 crores. Corporate slippages came predominantly from our previously disclosed stress book. Of all corporate slippages in the quarter, 98% came from the BB and below pool. Net slippages in the quarter were 2,124 crores, or 0.4% of gross customer assets. Of these, 1,394 crores came from corporate, 237 crores from SME, and 493 crores from retail and agri segments put together. Net slippages in retail are down 18% from the third quarter FY18. In the agri business, net slippages are down 30% compared to the third quarter FY18. I want to touch now on divergence. The bank has received an indicative list from RBI relating to asset quality divergence for the fiscal year ending 31st March 2018. The bank has been asked to classify 2 accounts as NPA. These accounts had a total outstanding amount of 225 crores, which constitutes less than 0.7% of last year's slippages of the bank. As it happens, both of these accounts have already been downgraded by the bank in the first quarter of financial year 19. In addition, the bank has been asked to make additional provisions of rupees 99.7 crores on two accounts already NPA as of March 2018. This provision has since been incorporated in the third quarter financials. NPA ratios for the bank improved sequentially, with gross NPA reducing by 21 basis points and net NPA reducing by 18 basis points quarter on quarter. We ended the quarter with a GNPA ratio of 5.75% and net NPA ratio of 2.36%. From the second quarter to the third quarter, we saw a net reduction of 14% in the standard BB and below book. If you turn to slide 51, you can see that the BB and below book now stands at rupees 7,645 crores or 1.4% of gross customer assets, down from 7.3% at peak. As the chart also makes clear, the bank's BB and below corporate portfolio has reduced quite significantly. A question that many have asked us at various points is, at what size is the BB and below book likely to stabilize? We have seen it come down quite a bit in the last few quarters, but how long more is it going to go? While we cannot answer that question precisely, we are making a new disclosure to offer the investor community some historical context on this portfolio. If you could please flip to slide 52, you will see that we have shown there the long-term trend in the size of the BB and below pool as a proportion of corporate lending over the past 11 years. The proportion of BB and below rated exposure was, in the stable state, around 2 to 3% of corporate lending book. It then rose sharply to a peak of 12.5%, and since then has trended back down and is at 4.2% at the end of the third quarter FY19. You could use this long-term trend to draw some inferences on the trajectory of this pool in the future. Having observed the rating upgrades and downgrades to and from the BB and below pool over the last few quarters, we believe the elevated rating downgrade cycle is now complete, and future quarters will continue to show business as usual levels of upgrades and downgrades from this pool. So far, the accounts rated BB and below have only had standard asset provisioning against them. To account for any potential residual risks that remain here, in this quarter, we have made an additional contingent provision of rupees 600 crores, roughly 8% of the BB and below rated book against this pool. Including this contingent provision, the total provisions and contingencies for the quarter were 3,055 crores. Of this, provision for NPA was at 2,755 crores compared to 2,686 crores in the second quarter and 2,756 crores in the third quarter FY18. The bank had a write-back of MTM provisions on G-Second bonds to the extent of 321 crores in this quarter. This compares with the total of 270 crores of MTM losses that were taken by the bank during the first half. Those of you who are interested in a detailed breakup of all provisions, as always, you can find that on slide 55. At present, the bank has an accumulated prudential written-off portfolio of 17,478 crores, of which 82% has been written off in the last 7 quarters. In other words, it is still relatively fresh NPA that sits in the PWO pool. Over the last 12 months, we have recovered 18% of the opening PWO pool. That should give you a little bit of a sense of the kind of recoverability one might expect to see over coming periods. Our provision coverage on NPAs has increased further this quarter to 75%. Please note that the contingent provision of 600 crores made during the quarter is not included by us in the calculation of the PCR metric. If you move to slide 53, you can see the credit cost trajectory of the bank over the last few quarters. Credit cost for the quarter stood at 2.07% on a gross basis and 1.32% once we adjust for the netting off of the recoveries from our written-off accounts. You might recall that recoveries from written-off accounts shows in the miscellaneous income line of the bank and not as a netting off against provisions. Net credit cost of 1.32% for the third quarter FY19 is the lowest in the last 11 quarters. Please note that the contingent provisions created in the quarter are also not part of the credit cost calculation. we would be including them in credit costs as per our tradition in the quarters when they actually get utilized to cover credit events. Let us now flip to slide 54, a slide that should be familiar to a lot of you by now. This is the slide that shows the bank's long-term credit cost trajectory. We show the trajectory here for two metrics, credit costs and credit costs adjusted for recoveries from write-off. You will notice that the gap between the two credit cost metrics has widened further during the 9 months FY19 to 44 basis points. You might recall that this is something we have been predicting over the last few quarters. As the recovery cycle picks up steam, adjusted credit costs are likely to diverge noticeably from credit costs, and the gap will narrow back in the other part of the cycle. With the trends we are currently seeing and the policies that we are contemplating and that Amitabh alluded to in his opening remarks, we expect the bank's credit costs would stabilize below its long-term average. With that, let's move to the bank's profitability metrics. I request you to refer to the section starting slide 11 in the earnings presentation. Net profit for the quarter increased 131% YOY to 1,681 crores. Operating profit grew 43% year-on-year. NII for the quarter was 5,604 crores, a growth of 18% year-on-year. Non-interest income for the third quarter grew 54% year-on-year to rupees 4,001 crores. This was driven by three major items. First, recovery. The bank recovered 998 crores this quarter from written-off accounts, compared to only 40 crores in the third quarter of FY18. You will find this amount rolled up into the miscellaneous income line. The bulk of the recoveries came from one large account in the PWO pool in the iron and steel sector, which constituted 714 crores of cash recoveries. As mentioned before, our trailing 12-month cumulative recovery on PWO pool now stands at 18% of opening pool. Driven by this recovery, total miscellaneous income during the quarter was 1,007 crores compared to 148 crores in the third quarter of FY18. The second major item in non-interest income this quarter was fees. Fee income for the bank grew at 16% year-on-year. This was led by a healthy 22% growth in retail fee income. Retail now constitutes 59% of the total fee income. Within retail, fees from our card business grew strongly at 23% year-on-year and constituted 39% of overall retail fees in the third quarter. Corporate credit fee growth was flat YOY. The third major item in non-interest income was strategic divestments. The bank sold its stake in two strategic investments during the quarter. These sales generated a gain of 342 crores, which form part of the trading income line. Let's now move to slide 15. You can see here that the net interest margin for the quarter stood at 3.47%, with domestic NIM at 3.66%. This is a material improvement sequentially. We would like to point out that the NIM in this quarter is higher by 5 basis points due to write-back of some interest reversals on the one large recovery that I mentioned before. Operating expenses growth for the quarter stood at 18% year-on-year, and for 9 months stood at 15%. The annualized operating expense to average assets ratio stood at 2.15%, flat sequentially. We remain on track for our goal of cost to assets under 2% in 3 years. If you look at the next slide, slide 16, you see that the yield side of the equation is showing strong signs of increase. The bank's MCLR has increased by 60 basis points in the last 4 quarters, and 56% of the advances are now MCLR linked. Over the next few months, existing MCLR accounts will continue to be reset at higher levels of new MCLR. This dynamic, along with lower slippages and interest reversals, gives us confidence that margins are likely to see good support through this year. As we mentioned at the beginning of the year, we expect NIMs in FY19 to be broadly in line with full-year margins last year. Let me move now to a discussion on deposits growth. Our deposit franchise had a very strong quarter. Overall deposit growth for the bank during the third quarter stood at 26% year-on-year. I request you to refer to slide number 7 in the presentation. On a quarterly average basis, CA, SA, and retail term deposits together grew 17%. Within this, SA grew 15%, CA grew 4%, and retail term deposits grew by 23% year-on-year on a quarterly average basis. CASA and retail term deposits continue to form a strong, solid base of funding for the bank and stood at 80% of total deposits. We continue to open branches at a steady rate. We opened 85 branches during the quarter, taking our total network to 3,964 domestic branches. Slide 24 highlights the strong growth of our wealth management business, Burgundy. We manage one of the largest wealth management businesses in India with assets under management of 1,29,651 crores as of the end of December 2018. Moving now to digital and payments, where our strength and leadership position continue. Let us start with slide 32 on the cards business. The bank had over 5 million credit cards in force at the end of the third quarter, making us the fourth largest credit card issuer in the country, with a market share of 12%. In the third quarter, 54,000 crores of card spends went through Axis Bank across our issuing and acquiring businesses. Slide 35 highlights the rising contribution from digital channels towards business growth. 50% of all savings accounts opened are sourced through tab banking, compared to 47% a year ago. Also, 47% of personal loan disbursements in the third quarter were through digital channels as compared to 26% a year ago. The next slide, slide number 36, highlights our capabilities and our strong position in the Unified Payment Interface, or UPI, space. During the quarter, we saw 251 million UPI transactions, with the total transaction value growing over 7 times year-on-year to 23,699 crores. At present, we have a registered customer base of over 37 million and a market share of 9%. In mobile banking, we have witnessed a YOY growth of 99% in transaction value. Last quarter, the bank's customers undertook transactions worth more than rupees 1 lakh crore on the Axis Bank mobile app. Let me now discuss loan growth and the trends we are seeing across our key business segments. The bank's strong deposit growth has enabled healthy loan growth. Domestic loan growth for the quarter stood at 18% YOY. The international loan book degrew by 19%. Our loan-to-deposit ratio at the end of the quarter continues to moderate and stood at 92% as compared to 95% at the end of the second quarter and 103% at the end of the third quarter FY18. Retail continues to be the key growth driver, growing at 20% year-on-year with continued diversification in portfolio mix towards products offering higher risk-adjusted returns. If you refer to slide 23, the growth in retail loans in the third quarter was led by personal loans, credit cards, and auto loans, which grew by 41%, 36%, and 33% respectively. The bank's strategy on retail assets continues to be centered around existing customers of the bank. 83% of retail assets origination in the third quarter was from existing customers. 96% of the bank's credit cards and 93% of personal loan originations in the quarter were from existing deposit customers of the bank. The bank's retail lending businesses are actively starting to leverage other customers across the Axis Bank group, in particular from Freecharge. More on this development when we speak about Freecharge. Sme Lending grew by 13% year-on-year. Term loans and working capital loans grew by 6% and 16% year-on-year respectively. Share of working capital to overall SME loan book currently stands at 79%. The focus here remains on building a highly rated, profitable SME book. At present, 86% of non-NPA outstanding exposure is to clients rated SME 3 or better. In the corporate book, domestic loan growth stood at 13%, while the international book degrew by 23%. Within the corporate book, our mix has been shifting steadily towards better rated clients, as we have highlighted to you in the multiple prior quarters. This shifted strategy continues to show up as a noticeable lowering of our risk-weighted assets to total assets ratio in this segment, which gets us to the bank's capital position. The RWA assets ratio of the bank improved further to 71% at the end of the third quarter. Driven by this improvement in RWA intensity over the last few quarters, the bank's capital consumption during the year continues to be modest. The bank actually accreted 9 basis points of capital to CET1 during the 9 months of financial year 19 after incorporating profits of the 9 months. In other words, internal accruals during the year have been sufficient to fund business growth during these 9 months and add to CET1 as well. The bank's CET1 ratio at the end of the third quarter was 11.77%, with a Tier 1 capital adequacy ratio of 13.07% after incorporating profits. Our capital position continues to be strong, and is sufficiently robust for us to pursue growth opportunities. Finally, let's take a quick look at our subsidiaries. In the strategy presentation that we have also uploaded today, you will find that one of our core strategies over the next 3 years is to materially scale up our subsidiaries. In that context, you should expect to see us continue to invest in these subsidiaries till they get to a scale that is commensurate with the bank's aspiration. Quickly touching on a few subsidiaries, Axis Finance, our NBFC business, had a growth of 21% YOY and now has a book size of 7,914 crores. The business continues to deliver great returns with an ROE of 18% and a NIM of 4.21% for the 9 months in this financial year. Gross Npa ratio of the business is 0.36%. Axis Securities is one of the fastest growing stock brokerage firms in the country, currently ranked third among brokerages in India in terms of total client base. The cumulative client base rose 17% year-on-year during the 9 months to 2.02 million. Axis Capital, the institutional equities and investment banking franchise of the bank, has been the leader in equity and equity-linked deals over the last decade. Overall capital market activity in the 9 months has been subdued, driven in part by the high volatility in the markets. Axis Capital executed 23 transactions during these 9 months, including 2 IPOs, 1 QIP, 4 OFS deals, 2 buyback deals, and 9 advisory deals. Axis AMC, the mutual fund business, continues to perform well with an 11% YOY growth in average AUM to Rs 81,622 crores for the third quarter, led by a 40% YOY rise in the number of client folios. Finally, Freecharge. Freecharge is being positioned by the bank as an engine that generates a large base of new-to-bank customers that are young and digitally native. If you flip to slide 65, you will see a new disclosure we are making this quarter regarding Freecharge and what it does for the Axis Bank franchise. As you can see on the slide, Freecharge has a strong customer pyramid which offers great cross-sell potential and customer access for Axis Bank at every stage of the pyramid. The third quarter was a great one for Freecharge with strong MAU growth and GMV growth, while also successfully completing its migration of all data to India to comply with recent regulatory guidelines. The quarterly active user base of Freecharge was approximately 9 million in the third quarter. As we close, allow me to re-summarize the key themes of the quarter. Profit performance of the bank during the quarter has been strong. Asset quality trends have progressed as per expectations. Provisioning has been strengthened. Core operating performance on deposits, loans, NIM, and fees have all been strong. And we are executing a clear strategy based on the 3 pillars that Amitabh spoke about earlier of growth, profitability, and sustainability, with a goal of delivering 18% ROE in a sustainable fashion over the next 3 years. With that, I come to the end of our comments. We'd be glad to take your questions.
Thank you very much, sir. Ladies and gentlemen, we will now begin with the question and answer session. Anyone who wishes to ask a question may press star and 1 on the touchtone telephone. If you wish to remove yourself from the question queue, you may press star and 2. Participants are requested to use handsets while asking a question. Ladies and gentlemen, we will wait for a moment while the question queue assembles. Thank you. The first question is from the line of Mahrukh Adajania from IDFC. Please go ahead.
Yeah, hi. Congratulations on a great set of numbers.
Thank you, Mahrukh.
Just had a few questions. Firstly, just on the watch list, obviously you've given a lot of details, but now the residual sectors are kind of the most sensitive sectors. So what would be your largest, the size of your large 2-3 exposures? And now can we assume that the risk of them becoming NPLs is really low?
So, Mahrukh, you will see on slide 51 that in the BB and below pool, we have shown the industry split. Power contributes 32% of what remains, and infra contributes 24%. So that between that, you're at almost 56% coming from just the 2 sectors. The largest single exposure in BB is an exposure size of about 800 crores. There is only one account above 500 crores in the BB and above pool, and it is this one. It is in the power sector.
Okay, that's comforting. So basically now the risk associated with these slipping would be low, or anyway it doesn't matter because they are small sized other than this account?
Yeah, I mean, apart from this account, we are talking about accounts which are 100 to 100 crore kind of range. So in a business as usual manner, you will continue to see some slippages from there, but it's very easily digestible in any quarter's numbers.
Got it. And just some comments on your retail deposit growth, which was very strong. So it's heartening to see that. But what suddenly drove the infrastructure to deliver such good growth, after a lull for some time?
Yeah, so Maruk, first, one quick comment on sort of the mix of retail deposits, and then Rajiv will jump in and talk a little bit more about the magic ones he had. You will notice that over the last few quarters, we have specifically been pointing out that given the rate environment that's been out there and the expectation of customers with respect to interest rates on deposits, we have been shifting our strategy a little bit to say that retail term deposits needs to play an increasingly active part of our overall deposit strategy, which is what we've been trying to execute. And you will see that a lot of our deposit growth comes in that space. And as we try to compete, not just with our traditional competitors, but also competitors who have much higher interest rates on SA accounts, the RTD-based strategy is something that we've been articulating as an important component of what we're going to do, and that Rajiv and team last quarter were able to execute really well. Rajiv, anything you'd add?
I think the shift has been in terms of the way that we've looked at deposits. And this is really work that's happened over the last 12 months, where the shift has moved from just looking at CASA to a more CASA plus RTD focused, sort of deposit strategy. And to be able to do that, we made some shifts in our branch head KRAs to look at not just CASA but RTD as well. And I'm glad to see that, like you said, the machinery is kicking in nicely.
Okay, and just one last question. Thoughts on insurance now, whether you would like to manufacture, what are your thoughts on manufacturing insurance?
Nothing has changed, Maruk, from what we last spoke. We have a good partnership with Max. We've both benefited quite nicely from that relationship. Of course, there from a strategic perspective, the bank needs to evaluate multiple opportunities in terms of participating in the manufacturing part of the value chain in some way. So we will evaluate all of those options, but there is nothing imminent that we need to talk about at this point.
Thank you.
Thank you. The next question is from the line of Suresh Ganapathy from Macquarie. Please go ahead.
Yeah, hello.
Hi, Suresh. How are you doing?
Yeah, I'm fine. Just quickly, I have a question for Amitabh. Rajiv was doing a brilliant job in the retail banking. So what is the need to shift him out of retail and move on to the corporate role? And in general, can you highlight what are the changes that you have been doing across the organization and across divisions in terms of management recruitment? And who is now going to take charge of retail at the bank?
Suresh, Rajiv, congratulations. Suresh, you've done a great job. Rajiv has done a great job in retail bank, and I think Rajiv and we both thought that it was a great opportunity for him to, move to wholesale. He has played an important role or kind of worked in the market side for quite some time, and he wanted a new opportunity and kind of fitted in well with what we wanted to do. We have in our strategy kind of slides which we have uploaded on our website today, talked about the structure under MD and CEO, and if you will see that we have also talked about some key principles there. We have talked about clearly defined product and coverage structure. We have talked about separating underwriting and, from the product and the coverage functions. We have talked about pulling operations and risk out of our relationship functions and all of that. So we have identified those key principles. Post establishment of those key principles, we have some positions which are open. And as and when those positions are filled, we will announce them. We have identified candidates internally and externally for each of those positions which are listed on that slide. We are very happy with kind of where we stand today in terms of the people who will be working in those positions. But it's only prudent to announce them when they actually join us. So please keep looking out for announcements from Axis Bank over the next 60 days. And we are confident we'll be able to fill up everything by then. So that effective April 1, we are humming together as one team and obviously trying to achieve some of the things which are laid out in our strategy slides.
Sure. And there's one last question for Rajiv. Even the non-retail term deposits have done very well. What is the thought process here? This is actually like a wholesale funding. And I don't know how well it gels with your retailization strategy, right? Because it's a bulk deposit basically, right?
So the what we are now looking for, and we clearly recognize the fact that ultimately how much we will be able to grow on the corporate side or on the lending side will be determined by, what kind of deposit growth we're able to get. And so therefore, there is a consciousness within the organization to be able to generate deposits. And I think on the NRTD side, what we are seeing is that corporates increasingly are looking at opportunities other than liquid funds to be able to deploy their short and medium-term surpluses. And if not anything else, just from an asset allocation perspective. And also, from our treasury folks, there's a greater focus on, how to get this done, especially with customers who may not necessarily have a credit relationship with us. And so therefore, this is also working well for us on the non-retail side.
No, but then how does it gel with your ALM piece? Because most of your lending would at least be for a tenure of a year or more. And these are very short-term deposits, right?
No. These would be, typically these are somewhere between 3 months and 1 year. So we get most of the retail deposits are the 1 year variety, but the non-retail is both 3 months as well as 1 year.
Okay, fine, thanks.
Thank you. The next question is from the line of Vishal Goel from UBS Securities. Please go ahead.
Hi, congratulations Amitabh, and thanks for sharing this detailed strategy presentation. Very helpful. I think my question actually is on this ROE target of 18%, just to understand it a little bit, more deeper, in the sense that you mentioned that, there is 10-20 basis point of operating efficiency which you can, take out. But on the margin and cost of credit side, so there is the whole, whether you bring down your, risk of the balance sheet and sacrifice margin, and therefore you bring down credit cost. How do you do both, basically, because you will need both margin expansion and credit cost going down to almost like 70-75 basis points to generate 18% ROE. So, yeah.
So let me try to answer the question. First is that, while we have shared 5 slides with you, let me first assure you that there are hundreds of slides which are behind this which have kind of led us to share just 5 with you, because a lot of effort has gone over the last 90 days in developing some of these strategic elements of our, the choices which we want to make as we go forward. As far as the balance is concerned, we will be driven by risk-adjusted return on capital, which is ROC. So the portfolio choices in wholesale and retail will be driven by that. I shared with you that our share of deposits and loans is still quite low. We see enough opportunities out there in the marketplace. If you just talk of wholesale, I think, we have suffered through the NPL crisis, but please understand and appreciate that we have deep relationships across the entire corporate sector. I think there is a huge opportunity out there. We need to just tap into those opportunities. Our products are no less than anyone else in terms of what they can offer and, how good they are and how digitally capable they are. So I think we are rejigging the bank and really asking our relationship management team to go and ask for our fair share of the business, both on the loan side as well as on the fee income side. With the combination of that, even if we go towards high-rated corporates, if we can get the other businesses, which we should, we have not, but we should, and based on the initial conversations I and Rajiv are having with various corporates, we're very confident we'll get there. Meeting our ROC, targets, as well as being able to maintain our credit costs in terms of what we have said as a sustainable, get it below the long-term averages, we believe should be possible. So that's where we are.
So, Vishal, one other way sort of to think about this is to say that and you alluded to all 3 of them, and it is an and. We need to do 3 things. Bring down credit costs, improve our business mix, and optimize on cost. Those are the 3 levers which will broadly get you there.
Cool. And this overseas loan book, which is declined in this particular quarter, is it only because of the repayment of a particular corporate plus something, or this trend should we expect to continue?
The big delta came in last quarter, and it is sort of, it continues. So yeah, there are 2 or 3 things that are going on here. Some repayments we're not sort of backfilling with new disbursements. Some asset quality stuff where we're making provisioning and actually reducing the book as well. So multiple things sort of are coming together there as a strategy. As we mentioned before, we are very clear that going forward, we want to do international business to the limited extent that we can continue to pursue India-linked opportunities. So that's what you should see reflected. If there is meaningful increase in that opportunity size, you will see us growing it. If we don't, we are not necessarily going to chase it. As Amitabh mentioned before, RAROC-shaped portfolio choices is what we're going to be about. And if there isn't adequate RAROC on that side of the business, we will continue to regrow it.
Okay, thanks, Jairam. And all the best, guys.
Thanks, Vishal.
Thank you. The next question is from the line of Prakhar Agarwal from Edelweiss Securities. Please go ahead.
Yeah, Kunal over here. Firstly, congratulations. And particularly with respect to the strategy and in terms of the growth, so we have already seen the...
Prakhar, I can't hear you very well. Can you speak up a little bit?
Agarwal, may we request you to speak closer to the phone, please? We are unable to hear you.
Yeah, sure. So, with respect to the growth, now we are seeing deposit growth being equally strong. So, maybe at the current level, how do we see the overall loan growth picking up? And you highlighted maybe we will be targeting both retail as well as on the corporate side. But within corporate, looking at what we had gone through in terms of the NPLs, any key learnings and the segments which we would focus and we would want to avoid on the corporate side?
We've already spoken about over the last few quarters the fundamental shift that's happened in terms of the credit underwriting. Today, about 85% of incremental lending is to single A and above, companies. So clearly, in terms of incremental lending, the change in strategy has already been implemented, and that is something that we will continue to focus on. There is also a shift away from term loans to working capital. And the third piece is something that Amitabh spoke about is to work much harder at increasing share of wallet with our corporate customers with the product suite that is available to us, so that we are able to deliver a relationship RAROC, which in turn will take us to the 18% ROE that Amitabh alluded to.
The Prakhar, our analysis shows that given the size of the bank at this point in time, we do not plan to, we will not sacrifice anything on our credit or risk management standards. Anything. As I said, and I know the appointment of Deepak, I think, should indicate that to you very clearly. We are not going to sacrifice that at all, and we still believe a possibility exists to be able to grow at a faster pace than what we demonstrated in the last, couple of quarters. That's all that we are saying.
Okay. And anything particularly with respect to the fee income and maybe how do we plan to leverage the entire franchise in garnering the fee income, or we are pretty much satisfied in terms of the streams which we have today, and there is not much in terms of the strategy which we are looking to the income side?
Yeah. Firstly, Prakhar, at the highest top of the house level, you're seeing fee income growth, coming in quite strong. 16% YOY growth in fees. If you look at the slide that we have put together, which shows the way fees are growing and the composition of that fee over the period, you will see that there is a lot of strength that has come in across multiple lines. So over a 2-year period, you've seen both the composition as well as the absolute amount of fees actually increase quite strongly. The big delta between the axis of a few years ago and the axis today is that a few years ago we were a very strong fee engine, but 1/3 of those fees came from corporate credit deals. They were bulky and they were deal dependent. The axis of today has come back to roughly the same fee yields that we were at a few years ago, but now the biggest fee components are cards and retail liabilities, retail lending, transaction banking in corporate, etc. Much more granular, more flow-based businesses. From here, the predictability of this going forward and the sustainability of this fee line is going to be quite strong, and that's what we're all working towards.
Sure. And lastly, in terms of the provisioning coverage, where we stand today, plus the contingency provisioning which we have created. So now, how do we look at it in terms of the coverage? Is there a further need to inch it up over the next 3 to 4 odd quarters, or maybe we are almost done and provisioning will be more maybe correlated to the incremental slippages now?
So, Prakhar, Amitabh alluded to this in his opening remarks, right? Well, one of the things that we do want to do is to use the opportunity to go back and look at our provisioning policies, particularly on the corporate side, and make sure that we are being appropriately conservative and appropriately quick in terms of provisioning. Now, that will result in whatever it results in, and if we need to take any incremental action in terms of improving coverage even further, we'll go ahead and do that. But whatever we do, we'll do to systematically, through a policy which we will be transparent with everybody about, so that there is no sort of management discretion and judgment that on an ongoing basis plays into this. So if there is anything to kind of come out here, we will talk about it, but for now there is nothing to report.
Okay. And subsidiary scale-up, any priority with subsidiary or maybe all of them is something which will be the focus area and we'll plan to scale up each one of them? Or is there any priority, maybe this is the subsidiary which we are looking at and that would be the focus area in the immediate term and others would be over a longer term?
So, Praful, if you really look at our businesses, there are 4 or 5 which stand out, which we need to focus on. Axis Finance is one, Axis Mutual Fund, Axis Direct. Axis Capital has always been number 1. Obviously, this year has not been good because of the markets. And we need to get more value out of, the free charge, subsidy which we have. Now, the scale will come through 2 ways, very obvious ways. One is organic. The message we've been giving to the subsidiaries, and I think everyone is on board, is that we need to scale them materially in a form and a shape so that they become more relevant in the marketplace and we start getting disproportionate share of, profits from them. But that will require some time. And the second is inorganic. And obviously we'll do that if it comes at the right price with the right kind of, acquisition target. We'll look at both. But for us, it will be very, very important if you want to bring one Axis together, that each of these subsidiaries actually becomes, a top 5 player in the businesses they are in, and we will obviously work very hard to get there, though it will take some time.
Okay. Yeah. Thanks a lot and all the best.
Thanks, Prakash.
Thank you.
Prakash, I just mentioned that obviously insurance will also figure in that scheme of things over the next 3 years, but we don't know when and how. Okay?
Sure.
Thank you. In order to ensure that the management is able to address questions from all the participants in the queue, we request the participants to please limit their questions up to 2. Should you have a follow-up question, we request you to rejoin the queue. We move to the next question from the line of Nilanjan Karfa from Jefferies. Please go ahead.
Hi, team. Thanks for the opportunity. A question to Amitabh and maybe to Deepak as well. See, when we look at that strategy that you have alluded to, right, the 3 things of cost to asset, credit cost, and business mix based on RAROC, it's quite easily visible that the credit cost itself on a post-tax basis could basically add, let's say, about, anywhere between 7.5 odd. And we need about 10% increase on a sustainable basis, which basically means, 20 basis points on cost to asset will add another 1.5%, and then business mix will be another 1.5, give or take. The question, therefore, is, where do you see this capital allocation, which I think is part of the business mix question? Where is the slack, on 2 counts, costs and on capital allocation? And I think I also heard, an operational risk getting talked about. Is it still existing, and what kind of plug-in have we done? And in the same context, the FX and foreign loans have been degrowing a lot. What is our thought process on the foreign branches and this part of the loan?
Boss, you asked so many questions under one question, but let's try to answer each one of them. Yes, I think in our slides we have shown how we'll get to 18%, obviously at a very macro level, and that talks about coming from 3 levers. One is obviously reduction in credit costs. Second is, portfolio decisions based on RAROC, and third is, cost reductions, strategic cost reductions. Now, some things feed into each other itself, but end of the day, we believe that if you look at these 3, and there are obviously a lot of sub-elements within it, we can't share everything, with the investor community at large. We believe that getting to 18% is possible, and that's what we want to strive for. You talked about international. Yes, you're absolutely right. Our overall loan portfolio on the national side has been coming down. We have stopped certain businesses on the national side in terms of the loans which we are doing. We are very, very clear as a strategy that whatever we do in our international subs or branches, whatever loans they give out, have to be linked to our Indian corporate or Indian relationships. Earlier in the past, we have had situations where we have done lending outside of that very defined set. Once those rules have been implemented, generally we are seeing a reduction in some of the exposures we have taken, which did not fall in this set, and I expect this loan exposure to continue to trend down. Over a period of time, which is fine with us because we believe that we have enough opportunities in the domestic market. Am I missing anything out which you asked?
Operational risk.
Operational risk, yes. Very important element of what we want to do. So a couple of things have been done. Firstly, over the last 3 years, a lot of operational risk controls have been hardwired into the system. Secondly, as I said, one of the important things we are doing is really pulling operations out from businesses across our entire portfolio of businesses. Third, we are talking about actually creating a very consistent customer experience. Fourth, I mean, from a risk management perspective, operational risk is being looked at on a very, very active basis. Fifth, we are creating a separate team which is going to go into specific customer journeys where we believe that the operational risk exists, where we have already hardwired it, but relook at it and see what more we can do to ensure that the operational risks are minimized even further. It cannot be a one-time activity. It has to be a continuous process. I think by basically stating to the enterprise and the bank that this is important and something important we want to look at, I think just the tone from the top itself will communicate a message down the line that is something which we are very serious about, and we will look at it very, very actively going forward. It's not that we are seeing some additional risk. We just want to be prepared, and we want to keep investing in it as we go forward.
So there is no risk per se which exists today. It's just you want to tighten the ropes.
Well, operations always exist, but yes, if your question is something has come up which is making us say that, no. It is just about making a statement that we have to be very, very, watchful on this count, and we want to, as I said, sustainability is an important thing we want to do, and we have to continue to invest in this area as we go forward. But there's no specific event which is making us make the statement.
Right. And a quick question to Jairam. You mentioned the agri slippages are down 30%. Just wanted to clarify, the net slippages that we mention in retail and SME, is that X of agri or including agri?
No, the retail one includes agri.
Oh, it's already included within that?
Yes.
Okay, great. Thank you.
Mr. Karsa, you're done with your question?
Yes, I am. Thank you so much.
The next question is from the line of Adarsh B. from Nomura. Please go ahead.
Sir, one question is on, hi, Jairam and this question is on the fee line again, in terms of sustainability. The corporate fee kind of contracted for a few quarters. Now it's like stable on a YOY basis. Have we come to a point where it can grow now? Like, is it granular enough that can grow, or you still have a period of readjustment of some of those bulky fee lines?
Hi, this is Rajiv. I think we are very confident that we should be able to see that number grow from here. It's been flat this quarter. As also, just to reiterate once again, the whole RAROC framework that both Amitabh and I have been talking about is the fact that for every rupee of the balance sheet that we are utilizing, there is a focus to push our relationship managers to be able to get at least 1 rupee of fee against that. And so therefore, we should be able to see, reasonable growth, particularly through transaction banking on the corporate side. On the retail side, if you look at penetration of insurance and mutual funds, etc., it's still in single digits into our savings account pool. And so therefore, in that sense, the runway to grow still continues to be fairly high.
Understood. And second question was on, again, capital and the risk-weight asset reduction that you are seeing to assets. Just wanted to understand incrementally where is this ratio. So on a stock level, can you continue to kind of get this down further, right? Because that can help you delay the need to raise capital for growth, right? We're talking about improving growth aspirations. So can you address that in the context of where the RWA to assets could move, given that you're predicting a business over the course of next 2-3 years?
Sure. So, as you have seen, Adarsh, from June 17 to December 18, RWA intensity has come down from 80% to 71%. That's a fairly steep move down. To your question of are there any more legs here, for the last couple of quarters, I've been saying that we are almost done with this and there is no further sort of reduction, but every quarter we sort of surprise ourselves and end up doing even a little bit more on that front. But I find it kind of hard to see how this can continue for too much longer from where we are at already. So yes, maybe there's a little bit more to eke out in terms of RWA effectiveness, but I think that story has played out to a large extent.
So in that context, if that lever is not available and we'll kind of grow at a faster pace than what we've done, we'll be looking at a capital raise maybe mid of next year, right? Is that and what are your thresholds on CET1 on that context?
Nothing much has changed on that front, others from what we have spoken about in the past. We are at 1177 right now. Remember that we have some warrants that are expiring in June, which will convert into equity as well, and that's another 40-odd basis points. So the starting position is quite comfortable, and if profit accretion continues at a steady pace, then that should be more than sufficient to account for the initial growth spurt that we're talking about. We will continue discussing, and if there's anything at some point, we will come and talk about it. As of now, we find our position quite robust from a funding of growth perspective.
Perfect. Sounds good. Thanks a lot.
Thanks, others.
Thank you. We'd like to remind the participants to please limit their questions up to 2. Should you have a follow-up question, we request you to please rejoin the queue. We move to the next question from the line of Manish Karwa from Deutsche Bank. Please go ahead.
Yeah, hi, congratulations.
Hi, Manish.
My first question is to Amitabh. Now, in the context of improving efficiency, obviously, we would be looking at cost growth. So I just want to check your thoughts on how are we seeing cost growth from here on? Which segments do you think we need to really stress and invest upon? And where do you think, in terms of distribution and all, we are pretty good and we may not want to put up more distribution there? And is there a absolute cost growth number in mind, which you will probably see over the next 3 to 5 years?
Well, we can't comment on a number at this stage, but, I would say that I mentioned even in my opening remarks that some of the areas of investments would be, one, to strengthen the core, which is around technology, analytics, digital, and some of those areas. You also see in the organization structure we are planning to put a person as a head, digital, digitization, which is reporting to the CEO. So obviously, we do plan to invest decent sums of money in that area to kind of take Axis Bank to the next level of digitization. Over and above that, we are talking about material change in our growth rates on the deposit side, and then obviously followed with the growth on the advances side. For that, we might have to reorient the structure in the branches and also ensure that on the car side, in the wholesale, we continue to invest in certain areas. So yes, there will be areas we'll invest, but at the same time, we'll look at every other part of the bank to see where we can take some costs out. What that number would be, well, it will depend on, what our overall growth rate is. So I can't give a number, but let me just assure you that looking for every penny in terms of savings will be an important thing we'll do. But at the same time, we'll not hesitate to invest where it makes sense to, create the right kind of growth opportunity for us in the future in the long run. So we'll do both.
Okay.
Manish, the the strategy presentation specifically talks about the same sort of thematic that we have discussed in the past on cost, which is cost to assets, bringing it down to 2%. So from that perspective, for medium term, if you're looking for any sort of medium term guidance, cost to assets at 2% is broadly what it remains.
Okay, thanks for this. And just a small second question. On the contingent provision that we made, is it just a one-off provision, or we would probably want to maintain a certain ratio against, this BB and below book, and we'll continue to make some provisions, over time as well?
So I'll ask Jairam to add if I missed out anything, but yes, this right now is a one-time provision which we have made, but we have also said in the opening remarks that we have conservative provisioning norms on the retail side. We are assessing how we can move to a conservative provisioning norms on the wholesale side, and this will be if we go through that change subject to approval from whoever has to approve it. If we go through that change, it will mean a permanent change in terms of how we make the provisions. It will be driven by a templated formula, so it is not kind of subject to some qualitative assessments. And if that happens, obviously, then we will have provisions happening on that basis. But Jairam, if you want to...
Yes, one minor point that I'd add, I think Amitabh has covered the key idea here. The one thought that I'd add to this is, we all know that a migration to Ind AS is imminent, if not in a few months, maybe in 1 year. But what we want to do as an organization, and what Amitabh has been pushing us to do, is to get ourselves ready for that migration and to be able to make sure that that migration process is smooth and seamless. And as you know, a key component of Ind AS is stage 2 provisioning, which is for assets that are not yet NPA. So we would want to make sure that we get to a point where we can seamlessly transition. So we'll work towards that, but there is nothing specific on that to point out at this point. And we are assessing all our internal policies, as Amitabh pointed out.
Sure. Thank you so much.
Thank you. The next question is from the line of Rahul Jain from Goldman Sachs. Please go ahead.
Hi. Good evening, everyone. So question to Amitabh. So basically, just wanted to pick your brains a bit more on the business mix side that you alluded to, because reason why I'm asking.
Excuse me, this is the operator. Management of Axis Bank, so can we request you to please check your phone? So there's a lot of echo on the call.
Hello, Karnal.
Hello, can you hear me?
Better now. Yeah, Rahul Jain, you can go ahead, please. Thank you.
Okay, thanks. So question to Amitabh. So basically, just wanted to pick your brains a bit more on the business mix, because if you can just share what kind of ideal business mix you would want to see, say, over the next 3 to 5 years, because retail is going through a different asset cycle, maybe not for you, but for some of the other players outside in the market. Corporate is almost, at the verge of having seen the worst. So what kind of business mix would you want to see which would help you achieve an 18% ROEs? That is question number one. And question number two is at the management level. So while, of course, you've articulated about the top management changes, but, should we expect some more changes to happen, let's say, at the middle level management, now that you are kind of, trying to, take out some of the operations from the businesses and all? So those two questions from Amitabh, and maybe one more housekeeping question that I'll squeeze in later on.
Okay, so as far as the business mix is concerned, as we stated, retail has already reached 49% of our portfolio. And we believe, if you look at our retail franchise on the asset side, a lot of it is actually, a majority of it is still coming from existing to the bank customers, and we expect to continue with that philosophy as we move forward, because we believe there's still a huge opportunity to continue to penetrate that franchise. And please also understand and appreciate that we have apart from number of customers which Axis Bank has, we have some subsidiaries which also have, a pretty huge set of customers we can tap into over a period of time. So I expect retail as a business to grow at a slightly faster pace than wholesale as we move forward. We have asked each of the business units to look at, what numbers they can deliver given their context and their what is happening on their asset side of the story. After looking at all of that, it appears that retail will grow at an incremental growth rate in comparison to wholesale. So this mix will change. And I think this could, over a period of time, maybe become 55, 45, something in that range. We don't want to go into more details than that. As far as the org structure is concerned, yes, N-1 are all identified and hopefully pretty much done. As some of these leaders take new responsibilities, and as we are relooking at our structures in wholesale and retail to drive the right kind of growth and the kind of the strategy which we have laid out for everyone, we might see some changes below N-1. We have a pretty large, solid pool of talent within Axis Bank. And we very strongly believe that some very good people are there in the system, and they will be excited to take on newer and additional responsibilities. So our hope would be that first we fill it with the Axis Bank people, but at the same time, there are certain white spaces where we need to find some talent from outside, and we'll not hesitate to do that as we move forward. So will there be some changes? Yes, more in the way we are driving the org structure, not in terms of additional people. As far as you mentioned cost, yes, if we believe that at the end of the day there are departments, functions, people who could be taken out, we will not hesitate to, but that can easily, they can find newer jobs, newer responsibilities within the Axis Bank system, because we want to get our growth mojo back. So is that something which you're worrying about too much today? No, we are not, because we believe that we'll be back to growth again of the right kind, and with that growth our employees will get more opportunities to grow internally, and they don't have to worry about, whether they need to look at opportunities outside. And we very strongly believe in the Axis Bank talent, which, I have had the opportunity to look at over the last couple of months and have been extremely impressed with. I hope that answers the question.
No, it does. Thank you so much. Maybe just one last quick question on the asset quality bit. So if I were to back calculate the addition to BB and below pool, it comes out to about 650 odd crores of additions, which is, I think, one of the lowest that we've seen. So does it mean that, the downgrade cycle, which I think, Jairam, you earlier talked about, has kind of, all of it has played out, and, it's going to be a similar number going forward as well? Or are you seeing are you worrying about any more, sectors which could give you some surprises going forward?
No, I think we are at sort of what one might call a business as usual state, Rahul. I think you will see the sort of a BAU level of upgrade downgrades on a regular basis. We can't predict exact numbers, but from a movement perspective, I think we are I think we are broadly there in terms of what some of the movements might be. As Amitabh alluded to in his opening remarks, we continue to look at some of the other stuff like some of the non-fund based exposures within BB, security receipts portfolio, things like that, as well as our non-banking assets, some of these areas as well, as you try to get a sense of where some of the risks might be. But to the core question of upgrade downgrade ratios, or the downgrade ratio in particular, has it gone back to normalized levels? The answer is yes, and we expect it to continue to be there. The upgrades to get out of BB are also normalizing, so you are also starting to see some upgrades, and we have continued to see them this quarter as well. So that seems it does look like we are reaching more normalized levels there.
Got it. Thank you so much.
Thanks all.
Thank you. The next question is from the line of MB Mahesh from Kotak Securities. Please go ahead.
Good afternoon. Just a couple of basic questions. One, if you look at the SME exposure, we've seen some level of deterioration in the portfolio. If you could just kind of give some color to it. Second, just kind of understanding this entire approach on the technical write-off or the settlements which is happening. Any change of opinion given that there's been a change in business heads? If you're willing to kind of settle at a lower amount, what is the underlying thought process on these two line items?
Sure. So firstly, in SME, has there been any deterioration? Not really. I think, there's a little bit of seasonality. You know how the smaller end of SME tends to have a Q3, seasonal high. But really outside of that, there isn't much to report here. If I look at, smooth and, trailing 12-month slippage rates in SME, there is nothing much to report there at this point in time. In terms of the book itself, the book continues to look quite robust. The SME 3 and above is still upwards of 85% of the overall book. So no, at this stage we are watching the SME book quite closely, particularly some sectors like real estate, etc. But really there isn't much to report in terms of the specifics of any new slippages in that segment. Your second question was. What technical write-offs? Technical write-offs. No, there has been no change there in technical write-offs. As you know, the bank has always been quite aggressive in writing off accounts very quickly, providing 100% and sort of writing them off. And as we've also mentioned in the past, recoveries from that technical write-off pool show up in the miscellaneous income line as against getting a write-back in provisions, and that creates some of the P&L dynamic that we spoke about during the course of the call. But in terms of where we are with the TWO pool or PWO pool, it's we are still at a place where 80+% of it is of the pool is fairly recent NPAs. So we continue to expect to see a noticeable amount of recoveries from that pool.
Sure. Just one question on the NPLs that you have. What will be the outstanding share of non-fund based exposure that you have?
We have 2,500 crores of non-fund based exposure, roughly 2,900 crores. Sorry, 2,900 crores of non-fund based exposure on NPAs.
And the security receipts book remains the same.
Remains the same.
At about 3,000 crores.
Yes.
Okay, done. Thanks a lot.
Thanks, Mahesh.
Thank you. The next question is from the line of Anirban Sarkar from Principal Asset Management. Please go ahead.
Yeah, hi. Thank you, sir. Just one question on the IL&FS exposure. So has any of this slipped, or is it a part of your NPA, or is it a part of your watch list, or is it outside completely? That's the first one. The second one is that the fresh additions to the watch list that happened in this quarter, so was that from downgrade of higher rated assets or upgrade of NPAs? What led to the addition? And the third one is that if you could throw some light on the investment gains that you made of 342 crore from the sale of strategic assets, what exactly were they?
Sure. On IL&FS, situation is fairly similar to what we spoke about on the previous call. Total exposure is about 800 crores, of which about 250 crores is fund-based. The rest is non-fund-based. The fund-based exposure, almost all of it has turned NPA during this quarter and has been appropriately provided for. Your second question on BB, and just to clarify, we do not have a watch list at this point. The watch list construct was wound down in March of last year. The BB and below or sub-investment grade pool that we disclosed, the upgrades and downgrades, as we were discussing with Rahul earlier, the upgrades and downgrades are a normal course of events. The big delta this time has not been from upgrade out of NPA into BB. It has more been downgrade from BBB into BB, but you have also seen a lot of upgrades from BB out of it, and hence on a net basis, you have seen the BB book reduce quite significantly from about 8,800 crores to 7,600 crores, a reduction of 14% quarter-on-quarter basis. So that was your second. On your third item or third question in terms of strategic sales, there are two strategic sales that we did, both of which were reported in the exchanges. We sold 1% of our stake in Max and we sold a small stake in NSDL. Both of those you can find the full details from our stock exchange notifications over time. I hope that answered your question. Hello?
Yeah, yes, sir. Thank you, sir.
Thank you.
Thank you. The next question is from the line of Ravi Singh from HSBC. Please go ahead.
Yeah, thanks for the opportunity. My question again on the strategy statement for 3 years, FY20 to 22. On the growth, will you be in position to peg some number now or maybe at the end of fourth quarter in terms of aspirational growth, whether relative to system growth or somewhere in the high teens, mid-20s? What sort of growth number you're looking at? And also, given the adjustments and changes in the systems and processes, this conservatism being the main theme, do you think there's a possibility that growth could actually be slower in next 12 to 18 months before it picks up on systems in place? Thank you.
Thanks, Ravi. Thanks for your question. On your first one, you're right. Typically, we tend to offer guidance forward-looking in the fourth quarter, so look forward to having that conversation then. At this point of time, we have nothing more to add in terms of specific growth numbers or targets for the medium term. We look forward to having that conversation with you at the end of the fourth quarter. In terms of what the conservatism that we spoke about earlier in the call, what that means for growth aspirations, the answer is nothing really. The actual aspiration number for growth is I'd be shocked if we saw the actual growth numbers kind of not move up, even as we moved towards a more conservative trajectory internally in terms of accounting policies, in terms of credit stance, etc. The intention is to say that let us do the right thing in terms of creating a strong balance sheet, but given the size of the opportunity that is available in the market and the positioning of the bank right now, we believe that even with that conservative stance, the ability to grow really fast over the next 12 months is quite high, and that's what we intend to do.
Okay, thank you.
Thanks, Ravi.
Thank you. The next question is from the line of Roshan Chutke from ICICI Prudential. Please go ahead.
Yeah, thanks for taking my questions. First of all, just want to understand this. You have about 55% of deposits as retail deposits as per your last Q2 LCR disclosure. Given that your CASA plus retail term deposits ratio is about 80%, does it mean the remaining 25% is bulk and therefore which is attributable to CASA?
No. So total deposits are made up of CA, SA, retail term deposits and non-retail term deposits. That is the total. So when we say CASA plus RTD is 80% of deposits, what we mean is CA plus SA plus RTD divided by CA plus SA plus RTD plus NRTD equals 80%. So the delta is NRTD.
No. So I'm talking about the retail deposits which you mentioned in the LCR, which is 55%.
Yes.
Now, if that is 55%, right, and the numerator, I mean, the remaining thing is only CASA, right?
I'm not sure I fully understood. Just to be clear, the LCR calculation uses a different definition of retail than what we use here. Here is the business segment definition of retail. There is a different RBI definition of retail that is there. If you're interested in doing a reconciliation between those two numbers, I'd request you to reach out to Abhijit and we can over email offer that clarification.
Sure, I'll do that. Thanks so much. And the other question is to Amitabh. It's a very theoretical / hypothetical question. What are your thoughts on insurance as a business? As in, is inorganic growth a better thing to do than organic, or pursuing an organic way of growing insurance business?
So you're talking, asking me as a CEO of Axis Bank or generally as a...
Generally, as an insurance expert.
As an insurance expert. Boss, we can take it offline. It's very unfair to the rest of the participants.
Sure. Okay, the third question
I'm sure we'll reach out to you through Vijay. Yeah.
You still have 13% of your loans which are base rate linked. What is the nature of these loans?
These are the old loans from the base rate regime, which are long gestation, primarily home loans, which are long tenure, and the customers never end up converting them into MCLR, and they continue to be base rate linked.
Okay, thank you so much.
Thank you.
Thank you. The next question is from the line of Anurag Jain from Canara HSBC. Please go ahead.
Yeah, thanks so much for the opportunity. Congratulations. Very good presentation. A couple of questions, mainly on the RAROC framework. So how do we, hope to blend the market imperative, our growth aspirations and the RAROC ambitions that we have? So while, currently times will be better, but in time, how do you hope to do that?
Yeah, I don't know whether we can actually answer that question in a pithy 1 minute soundbite. I think it is really important for us to ensure that we do actually do the trade-off that you're talking about. There are growth opportunities available in the market. The opportunities are different in different segments. RAROC is a framework that allows you to pick and choose segments and pick and choose pricing in these different segments. And the kind of trade-offs we intend to make with RAROC are to say we have, let us say, 25 different mini businesses within the bank. Each of those businesses at particular size have a particular RAROC, but at a different size might have slightly higher or slightly lower RAROC. It is our job as the management team to try and look at this plethora of opportunities that are available and craft over the next 3-year period a portfolio that optimizes the capital that we have available to us. As you rightly point out, it is not a straightforward task and it is not unidirectional, and so we need to apply our mind on it. But it is something that we are focused on doing, and we hope to use the framework as an objective way to make the appropriate trade-off in a rational and defensible manner.
Fair enough. So basically we'll still be able to meet our growth aspirations as well, So fair enough.
Absolutely.
Another question which probably was briefly alluded to, again on the RAROC framework, how do you, see working capital loans and term loans, and then how does it imply in terms of the mix for the two?
Working capital term loans, RAROC.
Yeah, so I think the way to look at it is obviously term loans come with higher levels of risk. Working capital being of a shorter term, the levels of risk are lower. However, yields are lower as well. But I think what is critical is that there are sectors, there are companies which are more working capital intensive, which also means that there are opportunities to do other businesses which are non-fund based with this customer. And so therefore the model really is that as you move towards more working capital, you're also improving the quality of the portfolio. But yes, there is some sacrifice in yield, but it then becomes an imperative to ensure that there is non-credit fee which is growing with that corporate at one level and for the portfolio. It may not necessarily happen all simultaneously, but that is what is what we work on really on a daily basis. And this trade-off that you're talking about, how do I get growth and how do I get profitability, is really what brings us to office every day.
Got that. Thank you so much. And if I can just squeeze in the last question, have we built in some cash position in the balance sheet? I see 8% cash in bank balances. Is it a precursor for growth going forward, or just a end of period number?
No, this is just end of period money lying in our ATMs and our branches.
Fair enough. Thank you so much. Thanks a lot and all the best.
Thank you.
Thank you. The next question is from the line of Jay Mundra from BNK Securities. Please go ahead.
Yeah, sir, most of the questions have already been answered. Just 2 data points, sir, I need. So last quarter we had mentioned the sum of all RBI dispensation restructured / all dispensation scheme, what is the outstanding number, sir, as of now? I mean, as of third
roughly 2,000 crores, similar to last quarter. Nothing has changed there.
Sure. And the last data point is, sir, I mean, last quarter we also mentioned some 2,800 crores exposure to non-fund based exposure to NPA. So we have provided 2,500 crores, which is the non-fund based exposure to watch list, I mean, to BB and below.
Yes. Yes.
But what is the NFB exposure to already NPA?
2,900 crores.
So is it 2,900?
Yes.
Sure, sir. Thanks so much.
Thank you, Jay.